I'm going to talk about two main areas. I'm going to say a little bit about what the data shows on investment trends in the Nordic countries. And then I'm going to move on to actually do a little bit of forward-looking work. I'm going to focus on prime offices, absolutely right. Nordics is more than one country, it's 4 countries, and it's more than capital cities. But having said that, I'm going to focus on those because I've got to focus on something. And then we'll wrap it up, hopefully in about 15 minutes' time. But to start with, let's just have a little reminder of the economic background to the Nordics. Partly this actually reinforces the 4 countries statement. It also reminds us why we're interested in the Nordics too. This is a chart showing GDP in a number of countries and the Eurozone as well, indexed back to 2008 Q1. So as far as the real economy goes to the beginning of the credit crunch. And there's some very sort of interesting movements on this chart. Not least the pink line and the blue line, the ones which are at the top at the end. The pink line is Sweden, the blue line is Norway. They weren't recession-proof, although in the case of Norway it was almost recession-proof. And you see we've got a point now where the size of the Swedish and Norwegian economies is considerably bigger than it was in 2008. Well, if I'd been talking 5 years ago, that wouldn't have been a surprise. You'd expect all economies to be considerably bigger than they were 5 years ago. But then when we compare to the other countries, Eurozone average for a start, about 3% down. Lines which actually kind of squeeze into each other, Finland, Denmark and the UK we've shown there at the bottom, are all considerably smaller than they were 5 years ago. And in the case of Finland as well, we had a deep recession. Now that's really to do with the size of the manufacturing base in Finland, which was hit in the early stages of the credit crunch. So, 2 things here. We're actually looking at relatively, well, almost absolute terms, strong economies in the case of Norway and Sweden, though for different reasons. And Denmark and Finland are, I wouldn't hesitate to use the phrase, also rans, but they're much more in common with what's happening in the rest of Europe. Now, if you look at that in terms of what's happened to consumer spending, which is a good indicator of retail demand, you get some of the same things coming through and one interesting difference. This chart shows what's happened in the last 5 years, that's the orange bars, to consumer spending in a number of countries, and what Oxford Economics in this case think are going to happen in the next 5 years. I don't think it's too far from a consensus view. And this time we put the northern Eurozone on for comparison rather than the Eurozone as a whole. So we stripped out the Greeces and the Italys and the Spains, which have dragged the average down. For Sweden and Norway, you get something that matches the GDP figures. We've had reasonably strong GDP growth. We had reasonably strong consumer demand growth too. Finland's interesting in that Finland was one of the countries which has struggled in terms of GDP, but consumer demand has actually not done quite so badly. Again, it's a reflection of the way the manufacturing sector of Finland has been hit, but the domestic economy hasn't done anywhere near as badly as you might think, given that, so we've seen some expansion there. Denmark, as you see, unfortunately much more like the UK there at the bottom, having many of the same problems of over-leveraged consumers, actually greater problems in the UK with falling employment and lacklustre growth. So very marked contrast between top and bottom here. Okay, moving on to the property market and what's been happening to investment in the Nordics. There's a chart here showing what's happened back to 2005 in total investment values in the Nordics, split up by country. There's a lot of information on this chart, but I think the key bits stand out quite clearly. The credit crunch had a big impact on property investment everywhere, including the Nordics. We saw a big squeeze, but since then we've seen a gradual recovery, and particularly in 2012, where we saw a bit of a spurt in activity in the Nordics. In 2012, investment was up everywhere, but notably up in Norway as well, which we'll come back to later. Some of this is reflecting the fact that part of the Nordic zone is a euro-free zone. So going back to the point from the previous speaker, it's seen as a hedge against the euro. But interesting, a lot of the investment is actually domestic or within the Nordics rather than coming from outside. This is a chart showing investment flows into the Nordics for 2011 and 2012. Actually, if you take it back 5-6 years, the pattern is pretty much the same. over 80% of investment in the Nordics comes from other Nordic countries or from the same Nordic country. It's domestic investment or within region investment. Of the rest, the vast bulk of it is coming from the rest of Europe. It has not, or at least not until very, very recently, been a major attractor of cross-regional capital flows. It started to change a little bit in late 2012 with purchases from the Canadian Pension Fund, in Norway in this case, which is one of the reasons the Norwegian figures are high, but still early days, although the robustness of the Nordic markets, or when I say robustness, I mean Sweden and Norway really, has started to attract attention from the rest of the world, and people are thinking more, or seem to be thinking more about Nordics as a location for property purchases. If you look at what different investors buy in the Nordics, you also get a very, very different picture. If you look at the Nordic investor buying in the Nordics, you get quite a diverse pattern of purchases. That's the pie chart on the left here. Offices are still the biggest segment, but pretty even spread of investment in all the other asset classes. Whereas if you look at cross-regional investors, you see retail and offices dominate, and if anything, retail is actually the majority share. Again, a reflection that retail demand in the Nordics, Norway and Sweden anyway, has been far better than anywhere else comparable in Europe in the last 5 years. So what's the overall impact of this on the property market in Nordics compared to the rest of Europe? Well, this is our chart of prime capital values, indexed back to the beginning of 1991. You can see movements up and down. These are in local currencies, by the way. By 2003, 2005, Nordics compared to EU 27 and not changed that much compared to 1991. Well, look what's happened since then. We can't say it's been a steady upward movement in the Nordics because it's not. It's been quite volatile, very volatile. But there's a clear blue water between the performance of capital values in the Nordics and what's happened in the EU 27. In particular, one is well above the pre-recession levels and the other one has struggled to get back there. Just in terms of which countries attract the investment, this is total investment, including domestic investment, and how it compares with other countries. There's a chart here showing investment in property in 2011 and 2012 by country in Europe. You can see how the big three dominate, particularly the UK and Germany, but interestingly, number 4 in 2012 was Sweden, number 5 was Norway, so they are creeping up in position. Denmark and Finland are relatively thin markets for investment compared to the big two. And if you look at that by city, again you get some interesting figures. London, Paris are the dominant investment centres in Europe. After that we get Berlin, but then we get Stockholm and Munich. Actually, Stockholm in 2012 attracted as much property investment as Munich did, which is often perceived as the strongest market in Europe, or the most attractive market in Europe. And also at 2%, obviously smaller, Copenhagen's smaller, but still significant on a European scale. What is interesting, however, if you look at the Investor Intention Survey, which we recently conducted, it's an annual survey where we ask a sample of investors about what their intentions are for the next year. And we look at what the respondents are saying for 2013 compared to 2012. The Nordics have actually gone out of favour a little bit. You see the Nordics are about 7% in the 2012 survey. That's the respondents saying they would invest in the Nordics, and about 5% in the 2013 one. So despite the strength of the Nordic economies, despite the relatively good property returns, they've gone out a little bit of favour as far as investor intentions go. Now what seems to be happening here, and it shows it best on the bars on the left, the respondents who say they're going to invest in Germany, is that fear about the Eurozone breakup and Eurozone chaos really has abated a little bit compared to last year. And it does seem that some of the interest in the Nordics was, again, as a hedge against what was happening in the Eurozone. And again, of course, that's 2 countries in the Nordics because some of them are tied into the Eurozone. So, some slight movement away, but this is what people say what they're going to do at the moment rather than what they will actually do. And just to summarise the investment section in terms of some of the big deals, I won't go into this in detail, just highlight the Canadian Pension Board investment in retail in Sweden at the end of last year. A lot of the rest of it, the big deals, very much within the Nordics. Okay, so that's what's been happening. We've had an increase in the attractiveness of the Nordics to investors, although very much a within the Nordic story with relatively small parts coming from outside. And of the people saying that they want to invest in the Nordics, probably it's gone off the boil a little bit. But let's just look ahead and see what we think is going to happen in the future. Now, I'm going to focus here, as I said, on prime offices in the big capital cities. There's far more to the Nordics than that. I fully agree with the previous speaker, but say it's a good place to start. And just look at what the trends are in demand and rents and total returns. What we have here is a chart showing increases in employment in what we call the office-based sectors, basically financial and business services and public administration, the past few years and the next few years. And comparing the capital cities in Europe with Eurozone North again, and with Southern Europe, just to give it a bit more scale as well. If you focus on the past few years, you get this picture again of Oslo, Helsinki and Stockholm doing quite well. Remember, Helsinki didn't do too well in GDP, or Finland didn't do too well in GDP, but the domestic economy of Finland, and particularly of Helsinki, has been rather stronger. And they've all been rather stronger than the northern Eurozone countries, and far, far stronger than the southern European countries. The one that stands out, of course, is Copenhagen, which has not had a good time over the past 3 or 4 years, very much caught up in the sluggish growth of the Eurozone and particular Danish problems, and actually seen a bigger contraction than some of the European countries, and it's reflected in some of the rental trends we've seen as well. Coming to the future, and this is the key part of the story really, in Oslo, Helsinki and Stockholm, we see more or less more of the same, more strong growth in the future, maybe a little bit better, maybe a little bit weaker. Eurozone North, more of the same again. Not so good, but it's positive. It's not a seminar about Southern Europe, but actually signs of hope in these forecasts for Southern Europe too. But the big story here is Copenhagen. It has been volatile for employment. And the big if here is if the Eurozone crisis doesn't rear its ugly head again, and if the sentiments of business confidence, if the surveys of business confidence and business sentiment are true, and they all indicate that the current weak pattern of GDP growth in all of the Eurozone, but places like Denmark in particular, is going to turn round in the next 2 to 3 years. The prospects for Copenhagen are that it could actually claw back some of that lost ground, and that's quite a key part of the story. And if you turn that to what has been happening to rents and what we think is going to happen to rents, you get this, just focusing on Stockholm, Copenhagen and Helsinki to start with. You can see how Copenhagen stands out as different from the rest. We've had weak demand growth. We haven't had much supply growth, but we've had rents fall since a peak in 2008. We think that forecast of employment growth is consistent with an eventual steady, but quite positive upturn in rents in Copenhagen. In Helsinki, actually it's one that seems to be going from strength to strength. We've had quite strong employment growth in the capital. Not much supply growth coming through and every prospect of further rental growth. Stockholm, actually not so good. That's not because of the strength of the economy. That there is one of these cities we've seen, of these three, we've seen some development. It has been Stockholm, which I think might depress rents in the short term before it returns to positive growth. I left Oslo off that chart partly because if you put it on, it dominates everything else. It's been more volatile and it's been stronger than the others. This is just a chart showing Stockholm and Oslo rental growth in the past and the future. You can actually see how Oslo was badly hit at the beginning of the recession. If you can cast your minds back that long, you might remember that the immediate impact of the credit crunch was to hit energy prices in a big way. It sounds like ancient history now. We still have a recession, but we have high energy prices. Once the markets managed to distill that and realise that the impact on Norway could be positive rather than negative, we saw a big return to rental growth in Norway. Going forward, we're talking about growth rates which are not dissimilar to what we're expecting for Stockholm, but without the downturn in the early years. So a positive, but not as strong as the bounce back period for rents in Norway too. Now, if you put these figures together, what we think is happening to rents and some assumptions about some marginal narrowing of yields as the financial situation eases, this is what we get for total returns in prime offices over the next 5 years in the Nordic countries. The darker bars are the raw figures, and these have been converted to euros in honour of the previous speaker, although the assumptions are that, I'm afraid to say that there are not going to be spectacular currency movements in the future, but we could debate that. The darker lines are the raw return figures. I've also put on here Munich as well, just as a comparator. I mean, Munich is the centre which is widely viewed as the strongest market in Germany and the one that's most attractive, one of the most attractive ones to invest in if people can find property to buy there. And what you get in the raw returns basis is actually a series of figures which are not too different to Munich. Maybe slightly weaker, pretty much the same actually in Stockholm, slightly better in Copenhagen, better in Oslo, better in Helsinki. So we're seeing on a raw total returns outward basis markets in the Nordics which, if anything, are slightly better than the preferred European centre. And what's interesting is what happens if you risk adjust these figures. Now, this is similar to Marcus's Sharpe ratio. It's not identical, and we've measured volatility in a slightly different way, but it's the same idea. We're dividing the expected total returns. This is a forward-looking view, not what's happened in the past, by a measure of volatility from the past. And what stands out there is Copenhagen, really. On our assumption of an improving Eurozone market and improving rents in Copenhagen, we get better rents. And also adding to that the fact that the Copenhagen property market has been actually far more stable than any of the other Nordic markets, and you actually get a much more attractive proposition for the future in Copenhagen. And what we're really saying here is that the future is not necessarily the same as the past. Norway and Sweden may have been the high flyers in the last 5 years, but it doesn't mean they will be in the next 5 years. Now, as long as the Euro crisis does abate, and we do see some return to growth in the Northern European Eurozone countries. The scale on here is difficult to interpret. I mean, it obviously shows Copenhagen as far ahead of the rest. I'd take their relativities rather than the absolute figures. Volatility has been much lower in Copenhagen. That's why it shows up like this on the chart. But you see, compared to what happens in Stockholm and Oslo, where the risk-adjusted returns are weaker than the raw returns, Copenhagen stands out. And if we don't believe Copenhagen so much, Finland and Helsinki stand out. And the common thing there actually is the Eurozone, two economies which are more tied into the Eurozone than the other two. So just to summarise, I think I'm at least up to the end of my time. The background for all the interest here has been strong economic growth or a strong bounce back, particularly in Norway and Sweden. And a couple of the countries are ranked quite highly in various investment league tables that have been produced for recent years. Very much the tale of within Nordics investment rather than cross-border so far. Focusing on offices, occupier demand has grown strongly in all of the capital cities, Copenhagen being the very, very big exception. And if you look at the forecast, well, the implication is we could be in for a different future than the immediate past. So watch out. So, thank you.